Beef prices have gone up 180% since 2007, but that's not even the real story. The Fed thinks high rates will fix burger inflation, while the labor market is already losing steam. This week's new ADP NER Pulse data is a wake-up call that they cannot ignore. Where's the beef? If you're of a certain age, that phrase should trigger a smile and maybe a little nostalgia. You're probably seeing that granny from the old Wendy's commercial holding up a tiny burger and asking that question. It still rings true today. Where's the beef? Thank you, Wendy's. You gave us a cultural classic and a market metaphor that still slaps. Back then, beef was cheap, fast food was fun, and clean eating wasn't even a twinkle in anyone's eye. Today, beef prices have gone up a staggering 180% since 2007 and nearly 64% since just 2020. That's a 9% annualized gain. For ground chuck, you can call that inflation on a bun. If the commercial ran today, the old lady would be asking, "Where's the Fed?" The chart of beef prices is ugly, no way around it. And before the Fed thinks about taking a victory lap on taming inflation, let's get one thing straight. This has nothing to do with tariffs. Beef inflation is supply and input driven. Herds are smaller because of drought, and feed costs have spiked because of fertilizer costs that blew up after the war in Ukraine. That's not a monetary policy problem. It's a climate and commodity problem. And yet, the Fed keeps holding rates higher for longer, as if that's going to magically make hamburgers cheaper. Maybe if consumers get so squeezed by high borrowing costs that they stop buying burgers, Wendy's will cut prices. But then what? Lower prices mean lower margins, layoffs, and stock pressure. The cure becomes the disease. That's not theory. That's economics in real time. If Wendy's tries to preserve its 62% gross margins by shrinking burgers, those same grannies from the commercial would be back in front of the cameras and they would be rioting. Shrinkflation is not a strategy. It's a warning label. I want to take a step aside and ask you that if you like this type of content, click like and subscribe. Let's get back to it. And let's shift gears to something that really matters right now, the labor market. Because while the Fed talks about healthy employment, everyone else is feeling a slow chill creeping in. St. Louis Fed President Alberto Musalem, one of the FOMC's most vocal hawks, said earlier this week that the job market is healthy and that 3% inflation is too high. He also said companies are adapting well to tariffs. Well, maybe in the executive suite they are. On Main Street, not so much. Here's the reality check. 71% of households surveyed in a University of Michigan sentiment report believe unemployment will rise in the next 12 months. That's the highest since 1980. That's not confidence, that's fear. And fear is a precursor to a slowdown. So, is the labor market really healthy, or is it living on just borrowed time? Well, we'd love to know, but the government has been shut down, which means we've been flying blind. No fresh data, no jobs report, nothing. The Senate may have cleared the way to reopen the government, but the House still needs to sign off. Dems are threatened to fight, and even if it passes, we might not get fresh labor data before the Fed's December 10th meeting. So much for data dependence. Right now, the Fed is data deficient. But one thing Musalem did say made me smile a bit. He claimed that the Fed had availed itself of private data sources. Great, because there's a new player in town that everyone should be watching really closely. ADP's new NER Pulse. The ADP NER Pulse is like an EKG for the labor market. It's built from real payroll data, not surveys, covering about 26 million private sector workers. Each Tuesday morning, ADP releases a 4-week moving average of job gains or losses, a weekly labor market heartbeat, literally. In other words, we don't have to wait until the first Wednesday of the month anymore to know if the patient is still even alive. This is private data, real payrolls, hire and separation records, direct from employers, not government estimates. That means no shutdown interruptions, no sampling games, no delays, just the hard truth, published weekly. And the latest ADP Pulse is flashing red. For the 4 weeks ending October 25th, private sector jobs turned negative. That's right. an average loss of 11,250 jobs per week, the first outright contraction since ADP began the series. The line on the chart is sliding downward from modest growth in September to steady decline through mid and late October. That's not a blip. That's a trend. When you zoom in, the damage is pretty broad. Every major industry and region showed weakness. It's not one sector dragging things down, it's the whole field. Momentum hasn't just cooled. It's completely reversed. That means November's data will likely show another negative print, making it 2 strikes in a row. At that point, the Fed will have no excuse not to see the obvious. And this is why trend matters more than headlines. ADP and BLS numbers never match perfectly, but their direction trends always converge. When ADP turns negative, BLS follows within a month or two. That's the tell. Right now, the tell is flashing warning lights. The Pulse data also lines up with corporate earnings calls and PMI surveys, all pointing to slower hiring, tighter budgets, and workforce optimization. That's Wall Street code for layoffs. Meanwhile, consumer sentiment is cratering with households expecting higher unemployment. Fear on both sides of the economy, employers and employees, is how a soft landing becomes a stall. If the NER Pulse stays negative through November, it means the private economy is contracting in real time, even if official data hasn't caught up yet. That will put massive pressure on the Fed ahead of the December meeting. They can't claim no evidence anymore. The evidence is being emailed to them every Tuesday at 8:15 a.m. This is what real-time economics looks like. The Fed wanted signs of cooling. Now they're getting a chill. And if they wait for confirmation from the government's lagging data reports, the damage will already be done to jobs, income, and confidence. Markets will react next. The bond market will smell the weakness first, pricing in earlier rate cuts. Equities will celebrate that first, but as job losses turn into earnings cuts, the celebration will end, and it will end fast. This is how a late cycle economy flips to an early recession one. So yes, the labor market that looked healthy from St. Louis is showing signs of fatigue. ADP's pulse is the canary in the coal mine, and right now, the bird is coughing. So what should you do? Watch Tuesdays. Every week's number is a heartbeat check on the economy. And if the Fed wants to pretend that they don't see the monitor flatlining, well, the rest of us can at least hear the beep just fine. So your truth bomb for today is this. The Fed doesn't need to model the economy. It needs to check its pulse. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out. And help me out here. Give me some comments below. We're going to take the top 3 every week, and we're going to answer those questions in some videos coming soon. Go ahead, put those comments there.